Hello and welcome to a full guide to stock market / cryptocurrency data analysis with Python. In this video we are going to use Python for price comparisons, return calculations, cumulative returns, volatility comparison, return distributions, and finally some plotting. I'm also talking about why it is difficult to compare stocks to cryptocurrencies. So enjoy the video and be invited to code along. I recommend to have some prerequisites. First, you need a very basic level of Python. And you need to have some basic knowledge of statistics, so you should know what the mean, variance, standard deviation, and correlation is. Disclaimer, concepts shown in this video are not investment advice, and the video is for educational and entertainment purposes only. Alright, let's get started. First of all, we need two libraries: yfinance to pull stock or cryptocurrency prices from the internet, and matplotlib for visualization purposes. Next, we define a list of assets, and here we are simply providing the assets we want to analyze. And let's start with Apple, Microsoft, Tesla, and a non-tech stock, 3M. And we are pulling data for all those assets here by simply using yfdownload and provide the assets list. And we are defining a starting date as well, so we are just starting in the beginning of 2020. We are storing this result in a variable df for data frame and end up with a data frame like this. So you see, we are getting adjusted close, close, high, low, open, and volume. For this analysis, we only need the adjusted close column. So the adjusted close is simply the last price on a specific day, corrected for dividends or stock splits. So to index only for the adjusted close, we can just use df and then adjusted close. And with that, you see you're getting the last price on each day, starting in the beginning of 2020, going until today, or the last trading day, which was the 23rd. Alright, so let's store that in a variable because these are just our prices. Alright, so we have our prices in a data frame. Now, when you want to compare those assets, it's important to understand that you cannot compare them on a price level. Why? Because take a look at those prices. So 3M has a price of 160. Apple of 72. So 3M has more than double the worth of Apple. So you cannot compare those prices. Also take a look at Tesla. So Apple is 3 times worth Tesla, or was. It is not the case anymore, right? But anyhow, not 3 times, but rather 2.5 times. So how can we compare those assets? So first of all, I'm going to plot this. So you can simply use plot on a data frame to plot the time series of each column here. If I'm plotting this, I'm getting a totally misleading and wrong price chart. So if I read this chart here, I would assume that e.g. Microsoft outperformed Apple, right? But you will see in some seconds or minutes that this is not the case at all. So this chart is misleading and you are comparing different price levels. So you should never do that. That's important. And how can you solve that? How can you compare those assets? You can compare those assets by taking a look at the daily returns. So instead of the daily prices, we want to have the relative changes. So I want to have the daily changes of Apple. So mathematically, this is easy to calculate, right? So you're just taking this price, divide that by this price, and with that, you know that from this day to this day, Apple was rising by 2%. So if you want to have the raw return, you subtract the 1 and get this 2.3%. Apple was rising from this to this day, right? So pandas or Yahoo Finance, which has pandas under the hood, has a function to do this exact calculation you just saw on every single row here. And this is PCT change. So this is simply the relative change in each row. So if I apply that, I'm getting the daily returns, as you see here, right? So this number, you know it because this is the calculation behind this number. Just as a side note, if you are interested or want to work or want to write your thesis in quantitative finance, financial modeling, risk management, or whatsoever, you should be aware that you don't take those returns, but you take the log returns. I have a whole video on why you're taking these log returns and how they're calculated. I will link it in the video description. For now, we are working with normal, in quotation marks, returns. All right. So just as a side note, I will link this video in the video description. Anyhow, we have the daily relative changes, right? And with that, we can compare those assets. We can compare, for instance, on this day, that Apple was rising by 2.3%, 3M was rising by 2%, Microsoft by 1.8%, Tesla by 2.9%, and so on. And we can compare that on a daily basis. Now, what I want to know is not only the daily return, but I want to know how Apple was performing from, let's say, this date until this date. So I don't want to only consider one daily return, but I want to accumulate the return, right? So how can I do that? Let's do it raw first. So how is the math behind that? You're taking the daily return, add a 1 to that, and multiply it, or in other words, take the product with the next return and add a 1 to that. And with that, you're getting this return. So if you want to have a raw, you are subtracting 1 afterwards. But you can see that Apple from this to this date was rising by 1.2 something %, right? The calculation behind that is pretty straightforward. You're just taking the prices, take this price and divide it by this price, and then you have the exact same number, right? Where did I calculate that? Here, right? So this is how it's working under the hood here, right? So let's get rid of that all. I think you got that. And take a look at the relative returns again. So what I just showed you, so first of all, I'm going to store these returns in a variable, which I'm calling returns. And what I just showed you, I want to do on the whole data frame, on this returns data frame. So I want to have a cumulative return in each row. So in this row, I want to have the number I just calculated. In this row, I want to have the number and also include this return, right? So with that, finally, I want to know how much Apple was rising from the beginning of 2020 until today, right? So in this row, I have the cumulative return until today for Apple, 3M, Microsoft, and Tesla. So I'm doing the exact same thing as I was doing beforehand. I'm adding a 1 to this data frame. With that, you see I'm getting the returns without the subtracted 1. And then I can apply the cumulative product function. With that, you see, so of course you have to subtract a 1 in the end. With that, you can see the cumulative return on each day. That means that Apple from the beginning of 2020 on was rising by 108%. On the other hand, we have 3M, which was dropping by 30%. We have Microsoft rising by 50%, and we have Tesla rising by 887%. All right? So this is very nice to compare those assets. And you can take this now, so you can store that in cumulative return, and you can plot those returns now. And now they're comparable, right? And now you see a different picture. So to amend the chart, we can just take a larger figure size here. Maybe a bit too large. Okay, that should be fine. So let's take a look at that. You see that, of course, Tesla, as we saw in the numbers, was outperforming all here, right? But you also see that Apple is outperforming Microsoft, right? And if you remember on the price chart, you wouldn't see that, right? So cumulative returns, very important concept, right? Next, I want to cover volatility. And the volatility is a measurement which is usually calculated using the standard deviation. So the standard deviation is simply showing how much the asset is swinging around its own mean. So if we take our returns, we can apply the standard deviation function and see that Apple has a higher level of volatility than 3M. And we also see that Tesla has a distinctly higher volatility than Apple, right? I'll come to that again. I just want to integrate cryptocurrency into that because I think it's very interesting to also compare stocks with cryptocurrencies. So that's pretty straightforward. You're just scrolling all the way up and add, let's say, Bitcoin USD. Then you pull the data again, only consider the adjusted close, and I want to show you the prices data frame because this is important to understand. Now, Bitcoin is traded all year long, on weekends and also on holidays. But that is not true for stocks as well, right? You see you have NAN values here. And this makes it a challenge to compare stock returns or stock prices with cryptocurrency returns or cryptocurrency prices in general. Because you just have more rows here, right? So let's calculate the returns and then accumulate them and plot them. And now you see an interesting picture here, right? So there were times where the Bitcoin was taking over here. So in comparison with Tesla, so it was from this point on, if you just consider cumulative returns, it was outperforming Apple, 3M and Microsoft. And here it was quite dropping. And what I personally find very interesting, you remember that Tesla bought some Bitcoin, right? And here you see a very interesting pattern. So they are dropping quite similarly, right? But this is just an additional comment from my side. What I wanted to show you is that you can nicely compare also Bitcoin returns with stock returns here, right? So you see taking the cumulative returns from the beginning of 2020 and compare that with the stocks. Bitcoin was outperforming the three stocks, Apple, Microsoft, and 3M. But Tesla was performing way better, right? Anyhow, important now is that when considering the volatility of Bitcoin, so if I'm taking a look at the volatility now, you see that Bitcoin is even more volatile than Tesla, right? And you already see the changes to the volatilities, right? Tesla was at 5% before when we excluded Bitcoin. And that's the case because we are calculating the standard deviation on the stocks, and the stocks have on each holiday, they have zero return here. And this is flattening the standard deviation and gives a wrong picture of the standard deviations of stocks when you directly compare them with cryptocurrencies. So this is important to note here when you compare cryptocurrencies with stocks. There are ways to get around that, but this won't be covered in this video here. So just note it's on this level. So if you consider volatilities, it is hard to compare with stocks on a daily basis. So for now, let's take a look at the return volatility chart. So also Volagram. So let's take a look at returns, then screen for Apple, and just plot it. And with that, you're getting this volatility chart. So you see that on some days, Apple is rising by more than 10%, also dropping by more than 10%. But overall, it's not that volatile. Let's compare this with, let's say, Tesla. You see that Tesla has way more swings, right? And these swings are measured with the standard deviation, and that is why Tesla has a higher standard deviation than, for instance, Apple. And we can also take a look at the return distribution. So we can do that with a histogram. And this is a frequency diagram, which is sorting the returns into bins and then is measuring their frequency. So in this bin, I have returns from, I don't know, slightly below 0 until 4% or something like that. And this is the bulk of the returns. So I have over 600 returns on in this bin here. So to increase the bins so that it is more understandable, you could take 50 bins, and here you see the bulk is at 0% of Tesla here, right? So you see it's in this bin, which is around 0%, you have the bulk of returns. If you take a look at Apple, you have the bulk of returns here. And do you know why that is? That is because you've integrated the Bitcoin into that. So with that, you have a lot of rows containing zeros here, right? Because these are the days when the Bitcoin is traded, when stocks are not. So for now, let's only consider stocks here in this analysis. But I just wanted to show you that it is quite interesting to at least compare the cumulative returns of those stocks with Bitcoin. So let's pull that newly. Let's only consider stocks here. So now we have the real standard deviations here. And then you see this histogram. And now we have a clearer picture here, right? We have still a bulk frequency of at the zero profit, but also some here negative returns and some positive returns here. Interestingly for Apple, you see that this wing is a bit larger than this wing here, right? So there are more positive, so slightly positive returns on this wing here. And there are very small tails here. So these are the extreme returns. So minus 10 and plus 10. And just that you get a bigger picture, if you take this histogram and compare that with the Volagram here, which I just showed you. Sorry for that. You see that this is only occurring once, this 10 positive and 10 negative return, right? This is only occurring once here, and this is why you only have it once here, right? So there is this one here, and this is this one. So just that you see the coherence here. Anyhow, last but not least, I wanna have some more details on plotting, both volatility charts and also frequency charts, so histograms. I have a whole video which is more than 2 years old on cryptocurrencies on that, where I've analyzed everything. I will link it in the video description. So I will quickly recap what I was doing there, but I will also show you a better approach how you can work with subplots. So my goal is to have all volatility charts and also all histograms besides, so that I can directly compare Apple with 3M, Microsoft, and Tesla. So I just want to have 4 subplots here. And to do that, I can use figure axes as I was using in the 2-year-old video. Subplots, then define how many I want to have. So I'm just taking 4 here, so 2 times 2, and set the figure size to, let's start with 10 and 5. And with that, I'm just getting those empty 4 subplots. And these subplots I can populate. And the approach I was using in the old video is quite annoying, but I quickly covered that, or not convenient, not annoying, but not convenient. And that is by simply assigning those plots to the thing you want to plot. So 0, 0 is this plot, 0, 1 is this plot, 1, 0 is this plot, 1, 1 is this plot, right? And you would need to assign them all here. And imagine you want to plot 12 charts. It's just not good to do it like so, but I want to quickly show you that you can do it so. So you want to, let's say, plot the returns, so the Volagram of Apple. And with that, you see that you are populating this plot. If you take this one, you're populating this plot, and so on. So you need to assign 4 plots now, right? But I want to show you a better approach, which you can also use to do your own analysis. Of course, this is a quite advanced approach. So not very advanced, but if you're a beginner, this might be a bit too much, but give me the chance to let me explain what I want to do here. So again, this is not convenient, right? I want to assign those returns automatically. So what I can do is to rebuild this 0, 0, 0, 1, 1, 0, 1, 1 structure in a loop. And I'm doing that step by step. So I'm taking a simple loop here for I in range 2, take an inner loop for I in range 2, and print out I and j. And with that, you will see that I'm getting this structure, right? So 0, 0, 0, 1, 1, 0, so 1, 1. Okay, and with that, I can just assign those columns of the return data frame. Of course, I also need a counter variable, and there are many ways to do that. I'm doing that with a simple counter variable here, which I'm assigning to 0. And so let's comment that out for now. I'm just increasing the counter in each of the inner iterations. So with that, I'm getting a simple 0, 1, 2, 3, right? So I just want to count from 0 to 3 here. Reason behind that is, I'll show you what I want. I want to screen for this series, then this series, then this series, then this series, right? Inside this loop where I'm populating those plots, okay? So what I want is, I want to print out the returns and then screen for the first column, second column, and so on. So to access columns, you can just take columns and then you can index for those elements. So the first element here would be Apple and so on. So I can just take returns columns and pass the counter. And with that, you will see I'm just getting Apple, Microsoft, 3M, Microsoft, and Tesla, right? And this is what I can feed into this plot here now, right? As I only want to have the return series, of course, I want to also screen my return data frame for this name. So what am I doing here? I'm just pulling the return series for Apple in the first iteration. You see it here, right? This is the return series for Apple. Okay, so I hope I could make this clear. Now let's get to the interesting part. So we need those subplots here. Add them here. And now we are just using this logic here. So we are taking I and j. I just explained why I'm doing that, because it's a 0, 0, 0, 1, 1, 0, and 1, 1 structure. And then I'm going to plot. And now I'm doing what I deleted. So I have to, no, I have it here, sorry. And now I plot the Apple series in the first iteration, the 3M series in the second iteration, and so on, right? So I can get rid of this. And with this, I magically get nothing, because something is off here. So let's find out what. Yeah, of course you have to put in the counter increase afterwards. So with that, you see that I'm getting all volograms for those assets, right? If I want to title them, I can also give them a title by using this exact same logic. Only screen for the titles, which are these, and then just set the title. So with that, I'm getting the vologram for Apple, 3M, Microsoft, and Tesla. So you can increase the distance between those plots. I've covered that in this 2-year-old video, so you can check that out if you want to have more details here. That's it for now on those beautifications of the chart. But you can also already compare those volograms, right? So you have to take care of the scales. So Tesla has a higher scale here, right? 20 and minus 20. But you can nicely see that 3M is swinging way less than Apple, right? You can see it nicely here. And now you can also do that with the histogram. So you can take hist here, then take more meaningful bins, and take a look at the return distribution. So as you see, for all, the zero return has the highest frequency, right? But the wings of the curve, or of the bell curve here, are different for all those assets, right? And you can do some very interesting analysis with what I just showed. And yeah, I recommend to play around with that. So in the 2-year-old videos, I was analyzing cryptocurrencies, now stocks, but of course for cryptocurrencies it's the same. So just change the assets here to cryptocurrencies. Last but not least, let's take a look at the correlation of those assets. So we can get rid of that. So we can just call the core function on the correlation, on the return data frame, sorry. And here you see how those assets are correlated. And you see, what might not surprise you is that Microsoft has a very high correlation coefficient with Apple, right? So Microsoft is highly correlated with Apple. Same business model, right? Biggest competitors. Apple is not highly, but also not, I missed the word, not slightly correlated with Tesla, right? But it is even less correlated with 3M here. So if you want to visualize that, I was working with Seaborn in the other video, so I can just use Seaborn as SNS and can create a heat map on this, and then you have it beautifully visualized, so you can see the correlations between those assets here. So the lighter the number, the higher the correlation. And you see Microsoft and Apple are highly correlated. And the least correlated asset is Tesla and 3M, which is also quite interesting, right? So check out the older video. That was one of my first videos, I think, or it was my 500 subscriber special. I think it's a very good video, but it didn't get the traction back in the days. Let's do all the stuff again for cryptocurrencies. So maybe we catch some interesting observations. So let's take Bitcoin, USDT or USD, Ethereum, Cardano, and what else can we take? I don't know. Binance Coin here. I hope that the assets are available. They are. So same logic here, right? Cardano, way lower price than the Binance Coin, way lower price than Bitcoin. So you could not compare those assets. But if you take a look at the returns and then accumulate those returns and plot them, you see a very interesting picture here, right? Look at the cumulative returns of Cardano, for instance, here. Insane, right? But overall, you see that you would be best off with the Binance Coin. Very interesting observations here. Let's get rid of that. Let's take a look at the volatilities. So Cardano has the highest volatility, followed by Binance, Bitcoin lowest volatility, and Ethereum here. Let's get rid of that all and apply this logic again. Now you can see, you can take a look at the return distribution. That is insanely interesting, at least for me, to see when you compare those cryptocurrencies, right? So Cardano has an interesting frequency here. BNB has this insane outlier, and yeah, Cardano has a negative insane outlier here. And yeah, but I think that's good for now. So let's take a look at the correlations finally. So we see, and this is quite interesting, we see that BNB is highly correlated with Cardano. Bitcoin even more correlated with Cardano, and Ethereum highest with Cardano, right? And you see these insane correlations in the cryptocurrency market, right? When you compare that with the stock market, they're way higher correlated in general. So yeah, that's it for this video. As said, be sure to check out the reference video. And I hope this video was interesting, helpful, and gave you some ideas. And I thank you very much for watching, and I'm looking forward to see you in the upcoming videos. Bye bye.